One of the ways that we educate options traders here at SMB is through a group mentoring program involving 4 traders who meet with me every 4 weeks for 2 hours. These sessions bring out some very important trading principles which all of the traders in the session learn from. In this last session, one of our students pulled up a trade that he was demonstrating for the group and admitted that he had mishandled a particular situation. On April 20th, he opened up a bearish butterfly trade, which works best when the market rallies and then pulls back. It does not work well when the market rallies and rallies and rallies some more, as has happened in the last few months with the Russell 2000 index, the very index that this strategy is traditionally traded in. This was a normal opening and a reasonable position to enter at that point. The market rallied after his having entered the position, and on May 6th, the trader added the second butterfly as per protocol, centered at the 1570 strike. He got the strike correct, but as you can see, he accidentally placed 20 of the butterflies as opposed to the 10 lot that the system would have required. At that point, his deltas became inappropriately large. At that point also, the trader should have taken the very simple step of reversing the execution error immediately after making it. Instead, for some unfathomable reason, he let the error stand and continued to trade the strategy. This is almost always a fatal error. Exactly why he decided to stick with the error is not clear, but I'll tell you that I've seen this happen before, and in some cases, it's because the trader does not want to take the loss associated with reversing the error, and there's almost always some loss taken from reversing a mistake, if for no other reasons than the commissions. In any event, the trader simply moved on, and on May 16th, he added the final butterfly to the strategy, the 1590, leaving the doubled up 1570 strike alone, which had already cost him big time, as you can see from the $9,200 loss that he was experiencing that day. Finally, mercifully putting him out of his misery, the trader the next day, May 17th, was stopped out of the trade prematurely, purely because the doubled up 1570 butterflies had gotten so badly beaten up in the rally that the trade was lost. On the day he bought those 1570 butterflies, they cost him $12.36 per fly. By the time he got stopped out of the trade, it had shrunken to $7.81 in value, a drop of 37% in 8 days. So if you follow the math, the execution error ended up costing this trader $4,500 when it should have cost a couple of $100 at most to exit immediately after the error was made. To be out of whack with your risk on a trade is never acceptable, and the fact that you will take a loss in getting the trade back into sync with your strategic parameters is not only irrelevant, but it's not very smart either. You simply can't allow your positions to violate your risk standards. So remember, the best time to reverse an execution error is 1 minute after you made that error, if not faster. We all make execution errors now and then. That's part of trading, but professional traders correct them promptly.